Options. Trading for beginners. Complete guide with examples. Options trading may sound complex at first, but with the right understanding, it becomes an exciting way to participate in the financial markets. Whether you're looking to protect your investments, earn extra income, or speculate on price movements, options can give you the flexibility that stocks alone don't provide. Let's break it down in simple terms. What is an option? An option is a financial contract that gives you the right, but not the obligation, to buy or sell an asset, like a stock, at a specific price within a set period of time. Call option, the right to buy a stock at a fixed price. Put option, the right to sell a stock at a fixed price. The fixed price is called the strike price, and the deadline is called the expiration date. Why trade options? Options are powerful because they offer 1. Leverage, control 100 shares with a relatively small investment. 2. Flexibility, make money whether the stock goes up, down, or stays flat. 3. Risk management, protect your portfolio against big losses. Key terms. You must know premium, the price you pay to buy an option. In the money, ITM, the option has value, profitable. Out of the money, OTM, the option currently has no value but may gain value before expiry. Expiration date, the day the option contract ends. Example. 1. Buying a call option. Imagine a stock, ABC Corp, is trading at $50. You believe it will rise to $60 soon. You buy a call option with a strike price of $55, expiring in 1 month. The premium, cost of the option, is $2 per share, and since one option contract equals 100 shares, you pay $200. 2 outcomes. 1. If ABC rises to $65, your option is worth $10 per share. 65, 55. That's $1,000 value minus your $200 cost, are $800 profit. 2. If ABC stays below $55, your option expires worthless, and you lose only the $200 premium, not the full $5,000 you'd need to buy 100 shares. Example. 2. Buying a put option. Now imagine you think the stock of XYZ Corp trading at $40 will fall. You buy a put option with a strike price of $35, costing $1.50 per share, $150 for a contract. 2 outcomes. 1. If XYZ falls to $30, your option is worth $5 per share, $35, $30. That's $500 value minus your $150 cost, $350 profit. 2. If XYZ stays above $35, your loss is limited to the premium you paid. Pros and cons of options. Pros. High potential returns with limited upfront capital. Can be used to hedge, protect your stock portfolio. Multiple strategies for different market conditions. Cons. Can expire worthless, leading to 100% loss of premium. More complex than buying, selling stocks. Requires discipline and understanding of risks. Tips for beginners. 1. Start small. Trade one contract at a time until you're comfortable. 2. Paper trade first. Practice with virtual money before using real capital. 3. Stick to simple strategies. Focus on buying calls and puts initially. 4. Always manage risk. Only invest money you can afford to lose. Final thoughts. Options trading is like learning a new language in finance. It may seem intimidating, but once you grasp the basics, it unlocks incredible opportunities. Beginners should start with small, simple trades and gradually expand their knowledge. With patience and practice, options can become a powerful tool to grow and protect your wealth.